Dave Barlow here with the Sell for 1% gang. We got Scott Hall.
Hey, yo.
Yeah, there he is. We got Jay Marinsky, Mike Hopper, and our very special guest to keep us all in line this morning, Rich Ciccone. Am I getting it down?
You're getting better at it, Dave. We're going to
Okay.
nominate you into the Italian-American Club pretty soon.
I'm going to get yelled at later on, I know. First by my daughter, then by my wife. Hey, you got it all wrong. I do it especially for them.
Yeah.
So, Rich, interest rates are a little like the weather. One day it's nice, next day, not so much. What's going on out there in the world of interest rates?
Well, right now it's the January of interest rates because it's pretty much not so nice. We've had a really bad month for the month of February in terms of progression towards a higher rates. The economic numbers, as we've talked about many times, have not been conducive to lower rates the entire month, and we're still at that high 6, low 7 kind of a rate right now on a 30-year fix. And the numbers tomorrow and next week are really, really big. So stay tuned and we'll see how things go. But we have a non-farm payroll number tomorrow morning, which is what the Fed is really looking at. They're looking at job creation, how many jobs are created or not created in the economy. So depending on what happens with that number tomorrow morning at 8:30, and then next week, the CPI number comes out. So we'll have a CPI, Consumer Price Index number, on Tuesday. Those two figures will be a determining factor as to what we're seeing in terms of rates moving forward, I think, for the next 30 days or so.
And so the one thing, because everything's kind of like the opposite of what you would think, we got somewhat good news this morning, although I would say it's not so good news, but jobless claims were higher than expected.
Right.
But for interest rates, that's good news.
Yeah, bad news is good news.
Yeah.
Bad, kind of like it's one of the conundrums of my profession, but that is correct. That we had more jobless claims than what were expected, and consequently, we're seeing the stock market rally a little bit, and we're seeing interest rates at least not go up today. I wouldn't say that interest rates have gone down today, but they quit going up, at least for the time being. So that's kind of where we are. And so bad news tomorrow, meaning that there weren't so many jobs created, would be good news for interest rates, because the bad news means that the Fed doesn't have to continue to fight a strong economy with higher rates. So that's why bad news is good news for interest rates, basically.
And so right now we are kind of straddling that 7% number right now.
Correct. And, one of the things I want to mention, Dave, because this is happening live right now as we speak, is that there are many changes happening in the conventional loan structure. There's something in the pricing of conventional loans. It's called loan level price adjustments, LLPA. And there's essentially a grid, and it's credit score and loan to value. And now they've added also debt to income into that. And those three factors, depending on what your credit score is, how much you're putting down, and what your debt to income is, all three of those factors determine adjustments to what the standard rate would be for you. So if a person calls me up and says, "What's your rate today?" I have about 5 or 6 questions that have to be asked before I can even begin to quote them an exact rate. That's just the reality of what's happening with conventional loans right now.
So if I called up, said, "Hey, Rich, I'd like to get a loan," what are those questions that I should be prepared for?
Well, I'm going to want to know what your credit score is, and a lot of times people have gotten a credit score from Credit Karma, or something like that. You know, that maybe is not the same credit scores that I would get if I ran your credit. So you know, if you really want an exact number, I'm going to have to run your credit, do a hard pull on your credit, and we're going to need to know how much are you putting down, and then I'm going to have to do a calculation to determine where you fall on your debt to income structure. So once I've run your credit, I can see what your debt is, and then if I can get a clear picture of what your income is, then I can do that calculation and be able to give you an answer. Now, that, I mean, I hate to make things complicated. As you know, I try to make things simple, but that's where we are in 2023 with the banking business and the way the federal government has become involved in everything that we do.
So if everything comes back aces, I've got excellent credit score, my debt to income is good, everything else, you know, that you're looking at, what's the best rate that I can get in today's world?
6.875 would be the rate right at this moment. So we're right there, as I said, straddling that 7% rate. That's where we would be.
And then let me ask real quick, and then if I'm kind of suspect, and you can still get me done, what kind of rate would I expect?
Well, let's say someone has a credit score in the 660 to 680 range. You know, they could be looking at mid sevens. It can go up that much, mid sevens to 7.6 on a situation like that.
Okay, so I mean, you're half a point to 5/8 of a point higher if your credit's just not quite as strong.
That is correct. Yeah.
Huh. That's a big difference, because you know, a year ago it was pretty much, you know, run my credit and off we went.
Yeah, well, we tried to simplify. As I said, you know, I've learned in 25, 30 years in business, you know, keep it simple, stupid. So, you know, I kind of like try to get a feel for someone, you know, in a conversation and give them a quote and try to stand by it as easily as I could. But the minutia has gotten much more prevalent now. So there's all these things that we need to consider when we're looking at someone's interest rate. And again, I try to make assumptions and give people a rule of thumb at least, so that they can decide if they want to make an offer and have some feel for where their payment would be without me having to run their credit. You know, I don't try to make it a difficult discussion.
Sure. So
hey, Dave, I do have some good news on one front.
All right, we'll take it.
You know, the loans we've been discussing here so far, conventional loans, but then there's also FHA loans. Mm-hmm. So with FHA loans, there's a change coming March the 20th, where the mortgage insurance, the monthly mortgage insurance, is decreasing. So it has been a factor of 0.85. So the mortgage insurance on an FHA loan has been 0.85 to whatever amount you're financing divided by 12. FHA is lowering that to 0.55, so 30 basis points lower on the mortgage insurance. So that's substantial in terms of someone's payment. That's over 0.25% lower on their payment on an FHA loan. So that's a little bit of good news, at least.
And so, for clarification, the LLPA does not apply to FHA loans.
Correct. FHA loans do not have loan level price adjustments. Those are conventional loans and nationwide conventional loans, Fannie Mae and Freddie Mac.
Yeah, and so it kind of seemed, you know, after the financial crisis and, you know, Freddie Mac and Fannie Mae, you know, almost became insolvent, and the federal government stepped in and helped out their own entities, so to speak, that they were really trying to push more people towards FHA financing. And I think I've read that as much as 60% of all home loans now are FHA.
You know, if you've read that, I'll go with your figure. I don't have that off the top of my head. I wouldn't say that my business is 60% FHA though. You know, I am still doing a healthy amount of conventional still, and still, all things being equal, conventional mortgage is a little bit of a better. And if someone has good credit, the better way to go would be a conventional loan because of some of the long-term mortgage insurance and upfront mortgage insurance cost of the FHA.
Okay. All right. Well, I appreciate your time. Thanks for the information. And of course, if anybody has a question, your contact information is here on the screen. Feel free to give Rich a call. He's been doing this a long time, has a lot of information, a lot of knowledge, and more importantly, a lot of experience to get you from point A of wanting to look at houses to point B, which is actually closing on your new home. So again, Rich, thank you.
Thank you, Dave. Appreciate it.
All right, guys, thanks for joining us here this morning.
Have a good one.